Well, thank you so much, Ryan, for that very stimulating introduction. It's a great pleasure to be with you all here this evening. So we've taken crossing the Rubicon as our topic this evening because we think we're in a fundamentally different environment going forward, and the way you think about defensive investing, the way you think about offsets needs to change accordingly. When Caesar paused, of course, on the banks of the river in 49 BC, he did so because he knew that once he crossed the river, there was no going back. And I'm here to tell you this evening that there is no going back towards a world of more inflation pressure, more volatility. You don't have a choice about that. You do have a choice about how you respond to it. And I hope, as well as explaining how we're thinking about it, it may spark some ideas for your own investments. So first of all, very briefly, for those who don't know about Ruffer, we're a privately owned £26 billion asset manager. We're a single strategy firm, and we've been doing the same thing since 1994 when we were founded. And that's very simple: protecting and growing assets in all market conditions. We've annualized at just under 9% net of fees. We have a very low correlation to other asset classes, more on that later. And so hopefully we're adding something very different indeed to the investment mix. Now, our formal objectives, the way we classify absolute return, which is what we do, are not to lose money on any 12-month rolling basis, and thereafter to generate returns above cash, meaningfully ahead of the return on cash. And in order to protect and grow your money, we need to be able to identify regime shifts in markets and, crucially, the offsets to those risks in advance of those pivots happening. Now, it's by doing this successfully historically that we've achieved that return stream. Here's Ruffer's long-term investment performance going back to 95. There were three major market crises in this period. We've managed to protect and grow capital through all of them. .com, of course, the credit crunch, COVID more recently, but we also made positive returns in all of the intervening bull markets too. Ruffer's in green here, UK stocks are in blue. Orange is a private client balanced portfolio, so think 60-40 stock bond, classic portfolio structure. The truth is we don't care what the stock market is doing. We're completely unbenchmarked. We're not trying to beat any indices. It just happens that we've beaten them as a byproduct, doing exactly what Ryan was talking about earlier. And I wrote it down: the easiest way to make money in the long term is not to lose it in the short term. And our strategy is all about avoiding catastrophic drawdown and allowing the power of compounding to work its magic over the long run. Now, I've already mentioned that we're a single strategy firm. We've got many different flagship funds. They all follow exactly the same objectives. They're just different structures for different investor types. One of our flagship funds is the Ruffer Investment Company, which is on the boilerplate tonight. So I've also put its long-term performance up here in green versus UK stocks in blue. So you can see that over its lifetime, since 2004, you've also had an equity-like return, but with much lower volatility. Now, the key to our strategy, and therefore to each of those flagship funds, is portfolio balance and genuine offsets. We always have protective investments in the portfolios to guard against the big risks we see in markets. We actually begin the process of portfolio construction not by trying to shoot the lights out, but identifying risks and the right offsets to them. We also always have assets to profit from more benign periods in markets, and this allows us to remove market timing as much as possible from the portfolios and to prosper in a wide range of environments. We don't want to have to time big inflection points in the markets. Nobody will consistently get that right. We'd rather be 3 years too early in terms of portfolio positioning than 3 minutes too late. And with the return of inflation, identifying what are real, genuine offsets has never been more important. So that's the history and the philosophy. What's the more recent story? Well, this year has been historically difficult, as I think everyone on this call knows, for anyone seeking shelter from the storm caused by historically aggressive central bank tightening, inflation at multi-decade highs, rising recession risk, COVID shocks lingering, you name it, it's been thrown at the market. Now, the table on the right shows a range of major asset classes, equities, bonds, and credit across the major geographies worldwide. And the bars show you what the maximum return available each quarter was from all of the assets on the right. So ignoring the detail, what it's basically telling you is that if you'd had perfect foresight for 3 decades, there was always an asset class that would deliver usually a substantially positive return until this year, when you've had 2 successive quarters of all conventional assets pretty much falling together. We think that's a taster of the challenge of the environment for defensive investors ahead. And this is how we've weathered the storm so far. Against the backdrop, we've managed to stay flat or modestly positive. On the left-hand side is the performance of Ruffer Investment Company's net asset value to the end of August, i.e. modestly up versus global bonds and equities, which are both heavily down. I should note that since that timestamp, the NAV is down a couple of percent. On the right-hand side is the attribution of how we've achieved a positive return against that very challenging environment. Our long-dated inflation-linked bonds have taken a bath, as you'd expect, with higher interest rates. Offsetting that at the top of the table are unconventional protections, especially those that make money from rising yields. And we think the ability to utilize derivatives in an environment where all conventional assets fall together is absolutely essential. So we've been able to keep our heads pretty much flat this year as everything else has fallen. I mentioned at the start we have a low correlation to other assets, but this actually undersells what the Ruffer history actually looks like. Here I'm showing you the correlation between Ruffer's returns in green and the stock market. It's a rolling 2-year correlation, so when that line is high, it's a strongly positive correlation. In other words, you're picking up most of the upside in rising market environments. During the shaded green areas, the market crises, you will see that Ruffer's correlation drops sharply and in some cases even goes negative. In other words, we're going up when the market's going down, and that's because we've identified the right offsets in advance of regime shifts. So we think the future looks increasingly challenging and crucially very different to the world investors have known in recent decades. And to understand why, it's worth pausing for a moment to think about what that world actually looked like. And I'd like to start possibly randomly here. It's an extraordinary facility in the American desert called Biosphere 2. It's basically a giant hermetically sealed greenhouse completed in 1991, the end of the Cold War, of course. And it was built to see whether mankind could create self-sustaining colonies in outer space. And researchers discovered something very unexpected. Trees in Biosphere 2 grew extraordinarily quickly, but they collapsed before maturity. And the reason it turned out was the absence of wind and the elements. In the wild, wind creates what's called stress wood. That's what makes trees gnarly and allows them to stand up to the elements. But without winds, the trees grew quickly in a straight line and they collapsed under their own weight. And we think that's a metaphor for what's been going on for markets these past decades. There's been a confluence of extraordinary benign events that have lifted all asset prices rapidly. Stocks, bonds, real estate, fine wine, classic cars, you name it, it's gone up. Here I'm showing you the long-term decline in interest rates in the United States, but I could have put inflation on here and I could have put economic volatility too. These things have been manna from heaven for asset prices. It's been the best era in history to own capital. But rates and inflation don't just fall randomly. These declines were driven by a cocktail of one-off events, things like China's opening up, things like the end of the Cold War, the small state revolution of Thatcher and Reagan, constant technological disruption, central bank focusing myopically on inflation control, and more besides. And the other thing, of course, that's grown very quickly alongside asset prices is debt. If you make money cheap, people will take more of it out. Here's debt to GDP for developed economies in green, going back to 1880, and emerging markets in blue. We are at World War II levels of debt and climbing. And the higher these lines go, of course, the more fragile the economic system becomes because it gets more and more sensitive to smaller and smaller changes in interest rates and inflation. and financial repression, which in plain English is just a world where over the long run inflation remains ahead of the rate of interest, becomes overwhelmingly likely, and that's one of the challenges you've got to protect against. Now, we've said for some years that we think with rates so low, another major economic crisis would force governments to intervene more aggressively in the real economy. We couldn't, of course, know what that crisis would be, but we thought it would reveal the world to be much more inflation prone than anyone thought possible. Here is UK and US inflation going back to the Wall Street crash in 1929. You can see that extraordinarily stable period of inflation for the last 30 years, and the most recent spikes taking us up to multi-decade highs. Now, of course, there are echoes of the 70s with an energy crisis and geopolitical strife, but actually the green shaded area is at least as interesting and probably instructive about where we go from here. This is World War II and its aftermath. It's all very volatile inflation driven by things like supply chain and labor market disruptions, the accumulated savings from the war being spent suddenly, much more activist governments. So don't be surprised if after big spikes in inflation, you see big drops as well. But don't believe that everything's gone back to normal, because these sorts of disruptions are going to last. Now, of course, the biosphere era lulled a lot of people into a false sense of security, including over inflation. And many have been caught, frankly, with their pants down. This is one of my favorite charts, showing that especially our lords and masters in central banking have been caught in that position. Here is UK realized CPI inflation in green from 2016 to the present. The dotted lines show you the forecast from our dear old Bank of England at every meeting since May last year, magically landing back perfectly at 2% in the nick of time. The truth is the central bankers have absolutely no idea what's going on. They've taken credit for decades of stable prices that they weren't principally responsible for. And of course, over time, greater inflation volatility will further erode their authority. But extraordinarily, the market still believes nothing has changed, to borrow a phrase from Theresa May. Here's the long-term inflation expectation in the United States, pretty much slap bang on its long-term average between 2 and 2.5%. The market is still betting all of this is transitory, and that means that betting on a regime change, more fundamental, permanent changes, is a very asymmetric trade. If nothing changes, prices don't have to change. If everything changes, there's going to be a lot of change. For now, of course, it's true that the central bankers are trying to put the inflation genie back in the lamp. Operation Stable Door has well and truly begun. They've been behind the curve dramatically, of course. Here's US wage growth in blue. That's a key inflation driver going back to the mid-80s, and US rates in green. And once upon a time, in the good old days, central banks tried to keep rates ahead of inflationary pressures. And the fact that inflation has taken off through wages now as well makes it stickier, and there's more hiking to come and more pain for assets. Now, as we already know, higher yields this year have caused a lot of pain for assets, including so-called defensive parts of the portfolios. One of the bigger shocks for many investors has been the scale of losses in their fixed income. What am I showing you here? This is a chart showing you the returns of a global bond index every year since Biosphere 2 was completed, and the dark green line is this year. So the key message is that we haven't experienced anything like this in the post-Cold War era, and that's before, of course, you factor in inflation. Note crucially that in a world of higher inflation, the correlation between stocks and bonds tends to be positive. In other words, they stop offsetting each other, as they have done for the last 25 years. They start moving in the same direction. So your principal protective asset quite quickly becomes a liability. Despite the significant declines, I'm afraid the bad news, ladies and gentlemen, is that we think conventional assets face quite a lot more pain. That's because of the rapid withdrawal of liquidity from global markets. And it's not just rising interest rates going up at their fastest rate in decades. It's not just quantitative tightening, but they sell the bonds that they've bought back into markets. It's the fact that commercial banks are unwilling to increase their own lending to take the place of that withdrawn liquidity. It's the fact that inflation means the real economy is hungrier for credit, and that's at the exclusion of risk-taking in the financial system. And there are various other money market dynamics that mean we think the liquidity crunch could arrive faster than people expect. What you do know with confidence, of course, and here's the 10-year yield in the United States going back 50 years, what you do know is that as debt climbs, as it has done for the last 40 years, the system becomes more vulnerable to tightening financial conditions, and something always breaks. What you can see here is that every time yields have spiked up and tried to get close to that long-run decline level with the dotted red line, there's been a financial crisis somewhere. Beyond the elevated short-term risk of liquidation, the landscape is changing profoundly. Multiple long-term factors point toward the more volatile and inflation-prone world I've been talking about. These include the net zero agenda, the energy transition, which is going to be extremely expensive in many dimensions, greater geopolitical upheaval, of course, notably a new Cold War with China, bifurcation of world order, and of course the appalling war in Ukraine, just the latest sign of that. Technology's continual disruptive influence, a rapid reversal of extraordinarily propitious demographic tailwinds, more stress from the physical environment. When rates got to 5,000-year lows, it was inevitable big government would come back with more direct fiscal action in the economy. That was going to prove inflationary in the real economy, not for assets as monetary policy has been. And then, of course, greater focus on the distribution of the pie, inequality. And so this is the big risk, that the financial and economic system has been optimized for life in Biosphere 2 with its low rates, low inflation, and low volatility. And that system is running headlong into a world which is more volatile and inflation prone. And that's a monster challenge for investors, because the most popular strategies, of course, that people enjoyed in recent decades, particularly defensive strategies, have also been optimized for that Biosphere 2 calm, stable environment. Think the 60-40 portfolio, even just dependence on conventional bonds as your primary offset. In fact, just to see how distorting ultra low rates really have been, consider this chart. This graph plots on the horizontal axis the risk-free rate, in other words, interest rates, and on the vertical axis, allocations to risky assets, so think equities and private equity and venture capital. And what you can see is that as interest rates fell, especially when they got to 0% and then sub 0% in some cases, allocations to risky assets got disproportionately larger. And that included allocations to those illiquid asset classes. So your money got tied up. And clearly the risk here is that as rates rise, you see something similar in reverse. In other words, disproportionate sales of risky assets as suddenly cash looks quite attractive. So as we draw to a close, here are our current asset and currency allocation pie charts on the left and right. This is for the Ruffer Investment Company, but I could have shown you the same thing for any of our flagship funds and they'd look extremely similar. Remember, we're doing the same thing with all of them. The portfolio is best understood as a three-legged stool there on the left-hand side. In green, protective assets against deeper financial repression. That's just where inflation stays ahead of the rate of interest. And that basket includes inflation-protected bonds and gold. In orange, we have equities to prosper from more benign market conditions and stronger animal spirits and economic growth. That's only about 15% at the moment. That's the lowest it's ever been for Ruffer. It's more usually about 40%. And in blue, a lot more downside protection if that liquidation thesis comes through. That's a combination of options that profit from falls in equity markets, higher volatility, currency volatility, deteriorating conditions in credit, and high yields in markets. And we also have a large allocation to fixed income because that gives us huge optionality at a period of massive volatility. But remember, the key thing with Ruffer's investment philosophy is that we're building portfolios to protect you whatever the weather. And that includes from us being wrong. That's why there's always a balance of assets. It's why we never bet all on red or black. It's why we start by identifying risks, not trying to shoot the lights out. And it's why the portfolio should be able to make positive progress and protect your capital, even if the macro views I set out today are wrong. And the fact that we're very different hopefully means we add something useful to other people's portfolios. This chart shows the return on the vertical axis in percentage terms and volatility on the horizontal, in other words, how much price is bouncing around. And it shows you what the risk return of a global stocks and bonds portfolio looks like on the right-hand side, and what happens if you add Ruffer in green in larger increments. It allows you to reduce your volatility and increase your return because Ruffer's offering something very different, and you can rebalance regularly into other assets. So there you have it, a single strategy focused on all-weather protection and growth, utilizing a very wide range of assets, making the most of our unbenchmarked approach. And that includes derivatives, crucially, in a world where we think all conventional assets are vulnerable to a reversal of those huge benign tides that lifted everything for a generation. Here are some of the flagship funds that we offer. We're super liquid. Our funds deal at least once a week, so you don't have to lock up your money for ages in exchange for illusory diversification benefits. You can rebalance quickly when you need to. I hope I've given you a good sense both of how we see the road ahead, the scale of the challenges, but also the opportunities for those prepared to avoid the received wisdom of the last 30 years and look relentlessly forward. And with that, I'll thank you for your time and hand back to the studio.